December 11th, 2025. Silver prints 63.58 per ounce. Financial headlines erupt. New all-time high. Silver breaks records. Precious metals surge. Retail investors rush in. FOMO kicks in. Everyone thinks they're watching the moment silver finally broke free. But here's the truth. No one on television is telling you. This price was not discovered on December 11th. It was decided weeks earlier, inside vaults most people will never see, when something broke in London. And what broke didn't just push silver higher. It irreversibly changed the structure of the silver market. Because $63 isn't the top. It's not even resistance. It's the floor. And the math behind what happened in October and November points to a move so large that most investors still can't psychologically process it. This isn't a rally. It's the closing phase of a trap that's been building for 5 years. Let's start where the headline stopped. What actually happened on December 11th? Yes, silver hit 63.58. Yes, that's a new nominal record. But the why matters more than the number. The day before, December 10th, the Federal Reserve cut interest rates by 25 basis points. Nothing shocking. Markets expected it. Analysts priced it in weeks earlier. Under normal conditions, silver might rise modestly on a dovish Fed pivot. But this wasn't a modest move. Silver didn't grind higher. It exploded, jumping over 245 in a single session. That's a 4% daily move in a metal that's supposedly boring, slow, and stable. Ask yourself something. When was the last time silver moved like crypto without a global crisis headline attached? Because this wasn't a reaction to monetary policy. This was panic buying of physical metal. The Fed cut wasn't the cause. It was the match. The powder keg had already been packed. The signal everyone missed. Look at what silver did before December 11th. For weeks, it sat between $57 and $60. No deep pullbacks, no waterfall corrections, no profit-taking collapse. Just compression. That's not normal price behavior. That's not sellers meeting buyers. That's a market where physical supply is already gone, and paper sellers are desperately trying to hold the line. When supply disappears, price doesn't fall. It waits. And that waiting ended on December 11th. But the real story didn't start in December. It started in October 2025. October 2025, when London broke. October is when the silver market quietly entered crisis mode. In London, the global hub of physical silver trading, something unprecedented happened. Silver lease rates exploded to 200% annualized. Overnight. Read that again. 200%. For a 24-hour loan of silver. To understand how insane that is, you need context. Normal silver lease rates, 1 to 3%. Stressed markets, 10 to 15%. 2008 financial crisis peak, around 20%. But 200%? That's not stress. That's panic. Only one type of participant pays 200% to borrow metal. Someone who must deliver physical silver and doesn't have it. Short sellers, bullion banks, institutions who promised metal they can't source. This wasn't speculation. This was forced scrambling for ounces that no longer existed. There was basically no metal left. Rona O'Connell, head of market analysis at StoneX, said it plainly in October. There was basically no available metal left in London. Let that sink in. London isn't a side market. It's the center of gravity for global precious metals. And by October 2025, it was empty. One trader told Reuters, "A lot of people were very stressed, to put it mildly." That's trader code for system failure, and the numbers prove it. The vault drain nobody talked about. In June 2022, LBMA vaults held 31,023 metric tons of silver. By March 2025, 22,126 tons, a one-third collapse in under 3 years. And by October 2025, when lease rates hit 200%, the deliverable metal was effectively zero. Everything left was already allocated. The buffer was gone. That's when the trap snapped shut. November 2025. The government confirms the crisis. 1 month later, something extraordinary happened. The United States government officially designated silver a critical mineral essential to national security. That designation is rare. Silver joined. Rare earth elements. Lithium. Cobalt materials governments worry about losing access to during crises. Why? Because silver checks every box. Essential to defense and technology. Vulnerable supply chains. Heavy reliance on foreign sources. Translation? Washington saw what happened in London and panicked quietly. Solar panels, EVs, AI infrastructure, military electronics, all require silver, and there isn't enough. The supply-demand math that breaks the market. The Silver Institute's 2025 World Silver Survey dropped in November. Timing matters. Here are the numbers. 2025 global supply, 803 million ounces. 2025 global demand, 1.12 billion ounces. Deficit, 307 million ounces. That's not a rounding error. That's a structural failure. And it's not new. This is the 5th consecutive year of silver deficits. 5 years straight of consuming more than we mine. Which means we've been living off inventories. Inventories that no longer exist. The 5-year drain nobody can reverse. Here's the cumulative damage. 2021, 250 men Oz. 2022, 237 men Oz. 2023, 184 men Oz. 2024, 215 men Oz. 2025, 307 Oz total, but 1.2 billion ounces gone. That's 1.5 years of global mine production erased. Those ounces came from London vaults, COMEX warehouses, private stockpiles. And now, they're gone. Recycling can't replace them. New mines aren't coming online until 2027 or later. The deficit doesn't shrink. It widens. ETFs, the trap. Inside the trap. Now let's talk about where silver is. The largest silver ETF holds 495 million ounces. That's 61% of 1 year's global mine supply. Add all ETFs together, over 700 million ounces locked away. Unavailable, untouchable, removed from circulation. And here's the vicious feedback loop. Rising prices, ETF inflows, physical metal removed, less metal, higher prices. Morgan Stanley called it exactly what it is. A self-reinforcing supply squeeze. There's no natural break, only price. Industrial demand doesn't care about price. Solar alone consumed 232 million ounces in 2024. By 2027, over 300 million ounces annually. EVs, AI data centers, 5G infrastructure. Silver isn't optional. There is no substitute that performs the same. Industrial demand through 2030 is expected to exceed 665 million ounces per year. That's 81% of mine supply gone before investors even show up. The all-time high lie media keeps screaming record prices, but it's misleading. Silver's 1980 peak was $49.95. Adjusted for inflation, $200 per ounce today, which means silver at $63 is still 70% below its real high. And 1980 was manipulation. 2025 is fundamentals. That's the difference. The gold-silver ratio is flashing red. April 2025, 107 October 2025, 78th December 2025, 65-68. Every major silver bull market began below 70. 1980, ratio fell to 17. 2011, ratio fell to 31. At gold, around $4,200. Ratio 40, silver, $5. Ratio 30, silver, $140. This isn't speculation, it's math. Y100 plus is inevitable 3 paths. All converge above $100. 1 inflation-adjusted 1980 peak. $200, 2 silver matching gold's long-term performance. $180, $190 to 3. Industrial rationing via price. $100, $120. First Morgan Stanley now projects $100, $120 by Q3 2026. Banks don't say that lightly. The timeline Q1 2026, $70, $80 Chinese solar ramps. ETF inflows accelerate Q2 2026. $85 to $100 US solar build season. Vault stress returns. Q3 2026. $100, $120 industrial panic. Second lease rate spike. Final thought. The trap was set in October. December just revealed it. The physical metal is gone. Industrial demand is unstoppable. Price is now the only rationing mechanism left. This isn't hype. It's arithmetic. And once the market fully understands that, $63 won't be remembered as the breakout. It'll be remembered as the last chance before triple digits.